Welcome to the Concierge CPA. I'm Jackie Meyer, founder of the Concierge Accountant Program and TaxPlanIQ software. This is a podcast for accounting firm owners and influencers who are pursuing world-class service. We discuss their path to excellence, their daily habits, and what influences them and their work. We believe that every person has a unique message that can positively impact the world. Stick around till the end of the show. We'll reveal how you can be our next guest. Let's go, y'all. Welcome to the Concierge CPA Podcast. I'm your host, Dr. Jackie Meyer, CPA. I have Dave Spence with me today, and we, somehow hadn't met until the last year or so, and we really hit it off talking about more advanced tax strategies. There's a particular one that I'm really excited to dive into today, which is called a LIRP, which is a life insurance retirement plan, is kind of the general idea around it. So welcome, Dave. I'm really excited to have you. Can you fill everybody in a little bit more on your background?
Yeah, thanks, Jackie. It's great to be here. I started out in a small town CPA firm doing tax returns and government audits here in Washington, D.C. And after 6 years of that, I kind of fell in love with financial planning. And at the time, you really couldn't do any of that inside a CPA firm, like you couldn't deal with products or anything. So I left public accounting and I worked in the financial services side. And that was a big transition because nobody believed me anymore.
Yeah, that happens, right?
Yeah, it's amazing. I just turned into a devil overnight. But but I was fortunate enough to land in a big organization with a big insurance branch on the West Coast in Los Angeles. So I really went from a tiny bedroom community to, one of the richest areas in the country, and there were 200 representatives there, and they would go out and reel in the big fish, if you will, and bring it in, and I would put together financial strategies for them. So it was wonderful, and I learned a great deal, every kind of planning concept from estate planning to buy sell deals and landowners and all that stuff. It was a lot of fun, but I fell in love with financial planning, and I've been there ever since. I haven't done a tax return for a client, since that time, and that's good 35 years ago.
Yeah,
I got my CFP right after the CPA, and then a couple of credentials after that.
Okay, yeah. So I was going to say, you're a CPA. You know both sides of it. You're a CPA. You're a CFP. You have several other credentials that we can get into, of course. It'll all be in the show notes. But I think something interesting you mentioned to me is that you were prepping returns for about $200 a pop back in the day. When I started my firm, which was 2010, I started out by prepping returns for about $150. $200 probably was worth a little bit more when you started, right?
Yeah. And I might, that's a good 40 years ago. So I could be off by a little bit. Maybe it was $10. I just
that would be interesting to look back. Yeah, I mean, it's always something to talk about with someone, like where they started in this industry, where they ended up. And you've had an interesting path because you did go into the financial advisory side. And then you've started a new company called Tax-Free Tutors. And it's really interesting what you're doing there. Tell everybody about that.
Yeah, Tax-Free Tutors is an effort to try to get tax professionals to think, and financial advisors. So I deal with both as kind of an intermediary, if you will, but get them to think in terms of creating tax-free income sources for the future. A Roth IRA is one, but the whole idea is to educate them to look beyond today. To take the blinders off and to take a look back. After World War II, we had the highest debt in the nation, in the history of our nation, and it was 120% of GDP. And that way, using that ratio, you can compare it to today's debt. Today, we're at 130% of GDP. So we've surpassed the worst time in our history. And what we did at that time was we raised tax rates starting in 1945 all the way through 1985. And the highest tax brackets were like 40 40%, 50%, 60%. They got all the way up to 94%. In 1945, it started out very high. And that's when Ronald Reagan was making movies before he was president. And he would make a movie for $100,000. If he did 2 a year, that was $200,000. And that was the start of the 94% tax bracket. Wow. And then he paid 6% to California.
Okay.
So he wouldn't make more than the 2 movies or $200,000. He would go to his farm and, enjoy the rest of the year and come back in January. But, it doesn't pay to work. But that whole period of time, tax rates were much higher. I have a calculator that I show people all the time that shows what your taxes would have been back in those years if you made $100,000 today or $1 million today. If you're single or if you're married filing jointly, all of that's in the software. It's amazing how much more we would pay in taxes. So what are we going to do now? Back then, we didn't have 10,000 baby boomers a day signing up for Social Security and Medicare, our 2 biggest budget items in the country. And we didn't have interest on the debt, which is now the 3rd biggest budget item. And it's even bigger than defense spending. So we're paying for this debt. And this is money that comes out of our taxes every year, and it goes to foreign countries that own the debt and, Americans that own the debt. But we don't get anything new out of those debt payments. The interest payments are for money we already spent in the past. So I'm telling them to don't think about just where we are today with a 32 or 37% highest tax bracket. You need to think in terms of it being in the 50s, 60s, even 80s. That it was in the 1960s. The highest tax bracket was like 88%.
So how do you look at it? Do you think we're really blessed that we're in such a lower rate at the moment, but it also concerns you because of the debt problem?
Yes. Former Controller General of the United States, David M. Walker, he tours the country now for PricewaterhouseCoopers and others as a consultant. He's telling the states to get ready because he was telling them when he was Controller General and he'd sign off on the financial statements of the U.S. budget. And he would always say in his cover letter, this is unsustainable. We're on a terrible path. Something has to be done. And nothing was ever done. He has said basically right now, you can't even raise the rates on the rich and solve this problem. It has to be across the board. If you tax just the people making over $400,000 a year to try to balance the budget and pay it down gradually, the effective tax rate would have to be 104%.
Wow.
That's not marginal, it's effective. So it's going to have to be a problem that we all have to face. And the longer we wait, the worse it's going to be. But we're not going to be in lower tax brackets. David said that in one of the videos that I've shared with you. We will never see tax rates this low the rest of our lives.
Okay. Yeah. So when Dave mentions the videos he shared, we're going to have some show notes for the podcast interview episode. But Dave is also our preferred sponsor at TaxPlanIQ for a particular strategy where he's provided a ton of resources called this LIRP. And so we're going to deep dive into that today. It's a really, really great one. For people that have already kind of maxed out other retirement options. They can use after-tax dollars to start funding these plans. But I can't just hop off the convo we were just talking about because there's so much to it. So we have a proposed bill right now in Congress that's saying, I believe it's a 32% consumption tax. And I was analyzing it this morning, and I feel like it's extremely unfair for lower income individuals because right now they're paying, less than 10%, if not getting a credit of some sort back on their taxes. And we're essentially going to have to put them in, paying over 30% when people in poverty can't even afford food in normal grocery stores anyways. So I don't think that solves our problems, but that does work towards what you just described of evenly trying to get the debt back into line. I just think it's really sad that it's going to have to impact everybody in a way, right?
Yeah. The sad part is that somewhere along the line, they came up with this modern monetary theory that says because the U.S. dollar is the nation's or the world's reserve, you can print as much as you want. And that seemed to be working okay. And congressmen love it because they don't have to tell their constituents that they're going to tax them more. So they keep believing that that's going to work, but they have not addressed the reality that if you have $10,000 in the economy and everybody has to live off that $10,000 and pay certain prices for everything, and then you double it to $20,000 and you got the same goods and services, they're just going to have to go up. You're going to pay more for the same goods and services. It's inflation, and that's exactly what's going to happen. Mm-hmm. So it's not really killed us yet. It started to be a problem recently, but it's going to get out of control where they're not going to be able to do it. Now, when inflation goes up, the first line of defense is to raise interest rates. Mm-hmm. And then you got all this debt comes back for refinancing, and you got to pay higher interest rates to refinance it. It's a vicious cycle. And the easiest way to get around it is just do nothing if you're in Congress.
Sure. Yeah. I mean, right now, we already feel like we've felt the pain of interest rates being high for, I guess, this decade or the last couple decades. But I mean, even those were 16, 20% in the 80s, so to speak, with mortgages. And so even that is a big difference between earlier decades. And to correct myself, it's actually a 23% consumption tax, not a 32%. So just want to make sure I get my math right there. But yeah, so there's a lot to unpack. I know with, Trump coming back into office, there is going to be a lot of extensions of TCJA, I would assume and expect. I think the only provision that came out with TCJA that really was kind of bad for higher income individuals was the SALT limit, where you put the 10K on married filing joint. And I know he's been pushing to double that, which would really probably only help people making $200K and above, and cause a $4 trillion additional debt problem. So it's just crazy how it all comes together, isn't it?
Yeah, it is. And let me give you a perspective of what $1 trillion means.
Yeah.
A million seconds is 11 and a half days. A billion seconds is 31 and a half years. And 1 trillion seconds is 315 centuries.
Whoa.
Now we are just throwing these trillions around like it's the new norm, but with 36 trillion, and it grows by $1 million every 40 seconds or so. So this just can't go on. It's going to kill the dollar, or going to kill the whole nation. We're going to default. We're just going to be backing ourselves into the corner. And without those baby boomers out there paying income taxes as much as they did when they worked, and with 10,000 of them going on the payroll, if you will, with Social Security and Medicare every day, it's just absurd that we're not doing something more about it. Yeah. And each president, when they were running, Trump and Biden, were both proposing things that were going to cost trillions of dollars more over the next 4 years. So neither one of them is taking it more seriously than the other. And I think we need to think outside the box. And we got to think about having tax-free income sources down the road when all this hits the fan and rates go up to 40, 50, 60%. We want to have more tax-free income on our tax returns. And that's Roth, and that's the LIRP, which we'll talk about. That's HSAs, anything, even home equity loans and reverse mortgages. All of these things ought to be strategies that we're playing with today, because apparently we got 6 to 10 years before they're going to finally face the music and make the changes. So let's use that time and today's rates to line up as many different tax-free income sources as we can. And you want to diversify them. If you just have all Roth, when push comes to shove, they may have to come back and say, I'm sorry, we're going to have to tax half the Roth.
Yeah, that would be scary, right?
So you want to have diversification there too.
Okay. Yeah, that's great. That was going to be my next question. As you're talking about all these dire things that might be coming, how do we protect ourselves, right? And so that is the solution, is producing more tax-free income sources, diversifying, like you said, because we don't know if they might start imposing tax on current tax-free solutions, right? So let's get a little bit into that, and let's talk about the LIRP. there's so much more we could talk about with the current economy and whatnot, but maybe we'll circle back to that if we have time, because I want to make sure that we discuss the LIRP, because a lot of people don't even know what this is. So give everyone kind of the elevator pitch. What is this strategy and how is it good for somebody?
Okay, yeah, it's often called a super Roth IRA. The reason is you're using after-tax dollars to fund it, and it grows tax-free, and you can take it out tax-free later. Mm-hmm. Now, it's done inside the wrapper of a life insurance policy. So that adds a new element of expense and complication and whatnot. You have to be healthy enough to get it and so forth. But for people that are already doing Roth and they're looking to diversify and have another one that may not be attacked as easily when they change the tax laws, a Roth is a nice complement. I always try to get people to maximize the Roth stuff first, but if they've got money left to invest, and that could be from assets, inheritances, savings that they've had over the years that just keep producing 1099s and they keep paying taxes on it, or it could be even in qualified plans where you take the money out at a 22 or 24% bracket today, and you avoid a 36 or 56 tax bracket later on. Mm-hmm. So you put the money into the life insurance policy and they take their piece of the pie, and it's more expensive in the earlier years. I'll get that out of the way right now. In the early years, the insurance company might be taking on $1 million death claim, and they might, you might be giving them $20,000 to fund this thing. Mm-hmm. So they're behind the eight ball a little bit. They've got to take some charges early on and be able to finance the probability of paying that claim. And then after the first 10 years, the charges go down. As you build up your own cash toward the death benefit, they're even charging you for a smaller death benefit, what they have to come up with. So the policy starts working over time. It's a little bit like a mortgage too. When you take out a big mortgage, you're not making much headway in the first 10 to 15 years, but after that, it's starting to sizzle and you've got a lot of value. So if you look at a LIRP as a lifetime plan, then you load it up with cash value, and you start taking the money back out in the later years, and you don't pay any income taxes on it. The death benefit pays off the money you've taken back out as loans, and there's still a net death benefit to your family that's tax-free. You can tap that death benefit in advance for long-term care expenses. There's all kinds of long-term benefits. And too many people get worried about life insurance or annuities are too expensive. Well, they need to be. Mm-hmm. An insurance company needs to stay in business. They need to finance their obligations in a rational way. But if you look at it like you should an IRA or a 401k, this is for the rest of your life. Mm-hmm. And a LIRP can be extremely powerful.
Okay, lot to unpack there. So funny you call it a super Roth, because I think you've been labeled as kind of a super CPA. So that's ironic between the two. But okay, let's kind of walk through different pieces of that. So first of all, we've discussed that this probably isn't for someone over 70, but even someone maybe 60 could get into a policy like this, do that 10 years, and then see a benefit if they let it go a little bit longer. Is that true?
Yes, it is true. A lot of people think that, the life insurance is best if you're young and you have a lot of time, and that's true, but you don't have all the restrictions that come with a Roth. You don't have to be 59 and a half. You could start the policy at 40, 45. In 5 years, you can take money out and use it for whatever you want, vacation or a business need or anything. And there's no cash limit like there is on a $7,000 Roth account. You can put in $20,000 or $50,000 or $100,000 a year into these LIRPs, and you take it out whenever you want. You can change from year to year how much you want to put in. So there's a lot more flexibility, and that gives it the super Roth, because you don't have to. Nobody pays tax when you die either. So yeah, it's got a lot of really cool additional features, bells and whistles that even a Roth can't match.
Sure. Okay. So I know you could go to a random financial company and you can put in just a couple thousand into one of these if you wanted to, but we discussed kind of where a cost benefit lies, and you're suggesting 15 to 20K plus. Do you say for the next 10 years, do you think you can commit, 15, 20K? What does that look like? And then the taxpayer kind of helps you mold the plan from there?
Yes.
Okay.
Yes, exactly. And if somebody's putting in less than that, it might be that they're stretching a little bit in terms of what they can afford for the long haul.
Mm-hmm.
You're putting more money into the policy than you would if you just bought term insurance. A term policy might cost you $2,000, but for that death benefit, let's call it $1 million, you could probably put in $50,000 or $40,000, right? Now, if you're not going to be able to do that every year, you're still going to be buying a more expensive life insurance policy than that $2,000 term policy. So because they know they're going to be paying that claim, only 98% of term insurance policies do not pay a death claim. So they take that into account when they do the numbers on their side. But permanent life insurance, close to 90% or more, will pay a death claim. So they have to fund them differently. The charges have to be different. If you're not going to overfund this contract and get the cash value to start being meaningful, then it's probably not an efficient way to do it. Okay. So I look for people that say, yes, I could do $20,000 a year, or I can do $100,000 a year. It's, whatever works for each situation, you want to be able to make that commitment, and it should be probably pretty substantial.
Okay. And the qualifications for health testing and whatnot, you said, are the same up front. Do you have to continue to kind of prove your health over a certain number of years, or how does that work?
No.
Okay. So that's a big perk. Yeah. Okay.
Once you're in, it's done. If you want to change it later on, I've had people get in there and say, well, 20,000 was easy. Now I could do 50,000. Well, let's see if we can increase the face amount on the policy so we could take more money.
I see.
But otherwise they can never change it once they give you a rating.
Okay. So let's walk through, for people that their heads are spinning a little bit because they're still trying to figure out how this all comes together and what the benefit is. Let's take like the case study that you brought to the table for me, where someone's putting $50K in a year. I'm not sure if you recall like what the age was when they started that or when they started taking the money out, but I'd love to hear a little bit more about what's getting funded, what the costs are up front. I believe you said it's about $10K a year for the first 10 years on that. So it's quite high, but then it starts turning around. And so at the end of the day, what's that end benefit they're getting for those initial contributions? And, how does it net out to such a great effect for the taxpayer?
Wow, you still knew about 2/3 of the facts there.
Well, I don't know what they got on the back end, so that's important. Yeah.
Yeah, this was a case with a 55-year-old standard rated woman who wanted to put $50,000 a year in for 10 years.
Okay.
So 55 to 65, and then starting in 65, take money out of the policy tax-free for 20 years. So the way the numbers worked out, that bought a $650,000 policy. That $50,000 could have bought a $5 million policy, right? But we want the death benefit to be as small as possible under the term, the IRS code definition of life insurance, so that it gets the tax advantages, but you reduce the charges. So the minimum face amount for that was about $650,000. You put the money in for 10 years, and we compared that to putting $50,000 into a Roth.
Okay.
Now, obviously, you can't do that on a regular Roth, but a conversion after taxes giving you $50,000 going in is similar to putting $50,000 into a LIRP wherever you got the money. So they both sides of the illustration show the $50,000 going in for 10 years, and then you could take 61,000 and change out of the LIRP for 20 years without it collapsing.
Wow.
And that based on a 6% growth assumption. And if you got the same 6% on the investments, excuse me.
No worries.
You got the same amount on the investments, the Roth IRA would produce 61,000 and change, the same number for 19 years, and then it would collapse.
Okay, so let me make sure I got the facts straight. She's 55. She funds $50K a year into the policy as premiums for 10 years.
Right.
Even after the net cost of like the 10K a year. So really she's kind of funding like 40K a year into this policy. She then turns around after 10 years and is able to start taking money out, which was about 60 or 61K per year for 20 years. So 10 years of 50K turned into 20 years of 60K. That sounds pretty good, right?
Yeah. Yeah. And the death benefit, which is available for long-term care expenses, is there the whole time, and it's not on the Roth. Okay. Now, when I say the IRA collapsed in the 19th year, that means that they were both comparable for that 20-year window, but the life insurance stays in effect. We don't show her taking any money out after age 85. She's enjoyed it for 20 years, and the cash value holds the policy up until she dies, and at death at age 100, it would be about $800,000 in death benefits that come tax-free.
Okay. And is it like taking a loan against the policy? Is that how she's taking that 60K? When you hear this word loan, what does that mean for this?
Yeah, when you put money into a policy, you can take it back as a withdrawal, which is considered a return of premium, or you can take it as a loan. When you take a withdrawal, there's no interest and there's no taxes. But the more efficient policies today will work with loans. So you might be better off just taking loans from the outset. So when you're ready to access the policy, you take a loan and they move your cash value out of the investment side and they put it into a collateral account, and they charge you based on that account balance, but they also still credit you on that money because they took the money out of their cash register to give you the loan. Your loan is still actually working inside your policy, and you want to have a zero cost loan scenario there, or you want to have one where they'll actually leave it in the index and it might earn 6 or 7 or 8 or 10% while they charge you 4 or 5. Mm-hmm. So you could actually be making money that you took out and spent.
Okay. So you're essentially kind of making money on yourself, kind of like borrowing from your own 401k?
Yes, but you don't have to pay the interest back at all.
Sure. Yeah. Okay. Yeah, that's pretty cool.
That $61,000 was taken out and spent on lifestyle needs, and no interest was paid along the way. No interest is paid upon death. It's all wiped out by the death benefit. So you get a net death benefit later. Mm-hmm. That policy will peak. It'll grow to, on the illustration, it'll grow to $1.25 million of death benefits. So if she funded it for 10 years and just died, she would have $1.25 million coming back instead of the 500,000.
Wow.
So it's still a great deal at that point. But if she can take the 60,000 out for 20 years, there's $1.2 million. And, she's still got a death benefit and no taxes on all that. She spent it, and she could actually still be making money on a spread inside the policy.
Mm-hmm. Okay. I want to go a little bit back to basics for 1 second, because I feel like, I'm what am I? A millennial, I think. And I'm like kind of right on that cusp of millennial and then the one above that. But I feel like people got a really bad rap around life insurance and just the words life insurance in like the 90s or so, maybe. There were a lot of scams. I'm not sure. I'd love your perspective. Why do people shy away from things as soon as they hear that term and like assume it's a scam? And how do you help assure people that this is a great option that's very viable and really helpful for a lot of people?
Well, it started back in '85 when I left public accounting and went to an insurance company.
Okay.
That's what I learned about people hating life insurance and annuities. But it's always kind of been there because of the front end charges. And I explained that a little bit before. When you're talking about a life insurance policy, they've got to pay $1 million death claim and they're pulling in a $10,000 premium. When are they going to make a profit on that?
Sure.
So they have to charge a certain amount for permanent insurance. And term is just so much different because 98% of them pay a claim.
Yeah, exactly. So, I mean, term, I think I see what you're saying. So people are automatically going to term insurance and how you might get quote unquote screwed. I don't know the better way to say it, through a policy like that versus these permanent policies.
No, I think it's vice versa.
Okay.
yeah, if you buy a term policy for 2,000 and you die, your family gets $1 million, right?
Mm-hmm.
So you obviously win there, and you didn't, spend more than $2,000.
Okay.
So, but if you keep in mind, that's a great thing to protect you during your working years and mortgage years and college years and all that stuff for your family. Then after that, you don't need it anymore. And you're older, so they're probably charging you $5,000 or $6,000. So eventually you're going to let that policy go, but it served its purpose. When you do a permanent plan, you end up getting the same $1 million on a level policy, but you probably paid $6,000 or $7,000 every year. So they think that doesn't make any sense at all. But we're taking it to another level beyond just permanent versus term.
Sure.
And we're saying, well, instead of putting $6,000 into that permanent policy, why don't we put in $26,000 or $36,000 and make it a tax-free investment?
Yeah.
So we get the tax-free wrapper that comes with it, and now we start earning money on the excess cash, and it starts to really, really sizzle after a while.
Yeah, that is so cool. Okay, let's talk about who's the best candidate for this. In TaxPlanIQ, we automatically suggest over 50 strategies around someone's prior year 1040. Eventually, we'll have additional questions around their current situation, like their age, how much they're putting into different retirement plans, et cetera. And I know those are important aspects because you want people to be diversified, right? We don't want all our eggs in one basket.
Right. Yeah. And that's what I love about the TaxPlanIQ software is it'll help us, jump in there to see if somebody's at a cash flow level where they probably got some extra money they could invest and they're wondering what's the most efficient way to use that money. But there's also, when using the LIRP concept, you need to look at assets too. Mm-hmm. And these may be assets that never really show up on the tax return. If somebody's overfunding max funding their 401k plan, then there's a good chance they're going to get to such a size that when they retire and then when they hit age 72, they're going to have to be taking RMDs that they may not even want. Mm-hmm. And we see that all the time in the tax world. And just good investment returns on those things are going to make them so big that when they have to take their money out, or as they take their money out, they may be in higher tax brackets because the tax rules changed. It may be because they're bumped up because of the amount of income that they're able to take, and your Medicare premiums go up. All of these things happen, but funding this LIRP allows you to have another tax-free source. So you want to have Roth and LIRP and taxable accounts as well. Spread the money, spread the risk.
Okay. And so do you still recommend that people max out their typical defined contribution plans like the 401k before looking at something like this? Or is every case unique and you want to really just dive in and analyze it?
I do like to dive in and analyze it. There will be times when I'll say maybe we don't want to max out the defined contribution stuff because it's going to get too big.
Yeah.
But not usually. Okay. Usually you want to do smart tax planning for today, but you just have to take the blinders off and say, well, how's this going to impact me in 20 years?
Sure.
And it could be dramatically different. Like David Walker said, you may be in twice the tax bracket you're going to think you're going to be in. So we got to get rid of the myth that we'll be in a lower tax bracket in retirement. If that's not true, then what should we be doing today? And I always tell people to max out what they can do, but on maxing out pre-tax contributions that are not going to be matched by an employer, for example, then you might be just as well off going Roth or going LIRP.
Okay, yeah. I thought it was interesting that you made sure to point out that this isn't a replacement for Roths or any other type of account, but again, just a diversified portfolio that's a component of it. Who is this really not for? Obviously, I mean, someone has to be able to be in decent health and age 60-ish or under. You mentioned a sweet spot with tax brackets that I would love for you to explain. I think you said 22 or 24% to 35%.
Yeah. If somebody's in a 37% tax bracket, you have to think long and hard if they're going to be in a 74% tax bracket later. But the reality is they're probably going to be in a higher tax bracket once they do increase the tax rates. So the 37 may be in their highest earning years, but it might be 50%, even though they're retired and just taking investment income and stuff. So the sweet spot I mentioned, the 22 to through 32 up to 35, that's because those rates are likely going to be lower than you're going to have in retirement, in my mind. So if you can convert money or get it out of your taxable accounts at 22, 24, even 32%, and you can put it in a sheltered area, be that Roth or LIRP, then you'll never pay taxes on it later when it comes out at a 50% tax bracket or 40% or whatever. So the 22 and 24 is like a no-brainer. So you don't really have to be rich. You just have to have the extra cash flow or extra assets. So you got somebody in a 22% tax bracket and they're living comfortably. They may not have an extra 20 grand a year, but if they inherit $500,000, you could move at least half of that money, if not all of it, into a LIRP over 10 years. And you'd be set for that money never being taxed again. So assets and or income. And I think if we can get people to think in terms of that, and just accept that the LIRP does make sense on a numbers basis, and I can show that to people all the time, then you want to use excess money, whether it's assets or income, but you want to set yourself up for 3 or 4 or 5 different tax-free income sources when they have to chop up the tax code and start taxing higher.
Okay, gotcha. So obviously we'll have Dave's contact information and whatnot within TaxPlanIQ for our wonderful users. If someone is listening or watching and they're not yet a part of our community, what's the next step? Just reach out to you and start a discussion? Yes.
I go to my LinkedIn page. I spend more time on LinkedIn than the others, but I'm starting to expand into the others. But yeah, taxfreetutors.com is the website that you'd want to look at. There's some free and some pay for resources on there, but it talks about, how to use that tax bracket sweet spot, the 22, 24%. And I'm on LinkedIn at Dave Spence, CFP is my account there. And just reach out, set up my Calendly account is on there, so we can do a 15 or 30-minute conversation about Roths and see how I can help.
Perfect. Okay. So I want to switch gears. Our time went so quickly. I know there's so much more we can talk about. Maybe we'll have you back for part 2, but we got to switch gears for a sec because there's one question I always like to ask, which I guess I'll go for that one first. One book that you would recommend, and I know which one you're going to say because we already talked about it and someone else just recommended it to me about a week ago and I just started reading it. And we had another podcast guest recommend it as well. So go ahead and share that with everybody.
Yeah, I would highly recommend The Power of Zero by David McKnight. And it's Random House Penguin. And it's available on Amazon and all kinds of places. You could go to davidmcknight.com or powerofzero.com. The whole concept behind the book is that we're on a train wreck, basically, from a tax standpoint, and we need to be planning for tax-free income and using multiple sources to get there. And he's on a mission to get 1 million people to get to the 0% tax bracket. And by that, you have just enough taxable stuff that your standard deductions would offset that. And you don't pay taxes on your Social Security, and you have a LIRP and you have Roth accounts and all that stuff. So it is possible at almost every income level, believe it or not, to get darn close to the 0% tax bracket. And when that happens and all the tax rates double, and if you're in a 12 or 22% bracket, you're still pretty well off. So Power of Zero is a great book. It's short. It's an easy read. And then he did another one after that called Look Before You LIRP.
Oh, that's a good title.
That's it. Yeah. Look before you LIRP, because it's like a marriage. It's like look before you leap and get married. You're going to be married to this arrangement for the rest of your life, just like an IRA that you can't get out of. See, everything else you can move around, but the LIRP, you're pretty much going to get married to it. So you want to make sure it has all the bells and whistles. There's less than 5 contracts right now, insurance policies out there in America that I would use for a LIRP.
Okay.
So you want to work with somebody that knows what they're doing and is independent enough to use any product that's available. And those will change by from time to time, because once an insurance company writes enough business, their actuaries are going to say, okay, that's all we can take on is from a risk standpoint now. And, they'll change the terms on the next one and it won't be as attractive maybe. So that's what I do is I'm always, looking for the best arrangements and keeping up to speed on all of that. And you want to get into a good contract. So look before you LIRP in power of zero, in the order of power of zero first.
Okay, awesome. And I hear you are a Pittsburgh Steelers fan and Ohio Buckeyes fan. So congrats on the recent one against, my dad went to UT Austin. I went to UT Arlington and they got squashed, but it was a really great game. My husband went to it here in Arlington, Texas. I'm curious, do you see a lot of analogies that cross over between sports and financial advising and tax planning?
That's a tough question. All right, every time somebody won't buy a LIRP, I cry, okay? I had both emotions this week when the Ohio State Buckeyes won and they're going into the national championship, followed the next day by the Steelers losing and being out of the playoffs. So.
Oh, I know, right? Gosh, yeah. I saw the news article about that. People were very upset about a fumble or something, right?
Yeah, they just haven't been playing well for a while. They lost 4 games going into the playoffs, so that was their 5th in a row, I think. And, everybody else was just peaking. Everybody was on a win streak. So I knew it was going to be tough.
Yeah.
But the Buckeyes are the story for us, and they lost to the team up north again this year, it's always the biggest thing. The Ohio State-Michigan rivalry is so huge, but that makes it fun, And I have fun when I do financial planning because it's not just a science; it's half art, half science. Mm-hmm. So you can get to the same output, the same goal line, going different ways when you're doing financial planning, just like you can in sports. So I like that you can be creative. You can always learn something new. You can, don't give up. And there's things you can make adjustments along the way. All of those things are comparable and they're both very exciting to me.
Yeah. Okay. Well, I don't know if you got into this topic with Dave, Dave Lucas, the CEO of TaxPlanIQ, but he lives in Ohio. He's a huge fan as well. So y'all need to definitely circle back on that one. We were going to try to get him like a championship t-shirt or something, but my husband said the line was way too long. Okay, yeah. So as we wrap up for today, Dave, anything else? I know there's so much more we could discuss, but anything in particular you wanted to make sure and share with our audience?
Yeah, it's probably the most important thing is to wake up and smell the coffee, if you will. We're overloaded with information, and information doubles, every day, it seems like. And it's so easy to just accept things the way they are. But unfortunately, this is one where we know they're going to get worse. I think taxes are going to be a bigger headache for us in the future. And there's good reason. There's the 2 people that ought to be talking to you about this aren't talking to you about it. So that you got to think yourself. You got to think about the realities. This debt is killing us. It's crushing us. We're going to have to raise taxes. And those 2 people are your tax advisor, tax preparer, and not enough of them do tax planning, Jackie. And
agreed.
I know you're trying to change that, and I love it.
Thank you.
They need to be thinking ahead and not just looking at last year and the year before and the year at hand. So they're not going to predict higher future taxes. They're not in the business of predicting, and they're crunched. They're under tons of pressure and they don't have the time. And when they give you your tax return, they want it to be the lowest bill possible. So they're not going to tell you, hey, why don't you throw on a $100,000 Roth conversion and pay the $30,000 in taxes? So that's one person that's not telling you. The next person is the person managing your money. And 90% of those investment managers don't do life insurance, so they don't know about LIRPs, and they don't want you to put money into LIRPs because they won't be able to charge you fees for the management. So it's a dichotomy out there that we need to be looking at this, and the two people that could be telling us that aren't.
Yeah. No, that's really interesting. You brought a lot of great insights to our conversation today. I really enjoyed it. I really appreciate you being here. We're really excited about our partnership with TaxPlanIQ and you and the Tax-Free Tutors. So thanks again, Dave. Thanks, everybody, for being here today. And on that note, we'll see you next time. Thank you for listening to the Concierge CPA, hosted by TaxPlanIQ. We believe that every person has a unique message that can positively impact the world. If you are a successful accounting firm owner or influencer who would like to be on this program, please visit JackieMeyerCPA.com, JackieMeyerCPA.com to apply. Please share this on social media and rate us so we can continue our good work. Join our Facebook group called Accounting Firm Influencers, or connect with me on most platforms under Jackie Meyer CPA. Thanks for being accountable to transforming our industry today.